and the impact that it had on Bitcoin returns and Bitcoin pricing as a result. And this came about because we've been studying Bitcoin, the time series of Bitcoin returns for several years. And every year or so we update it. And when we updated for COVID, we were quite surprised to see that the beta, that is the systematic risk of Bitcoin, went from essentially zero to an insignificant to a high significant number, something in the range of 2.5, and it looked like basically you would the beta of a tech stock. And so this was quite surprising. So I decided to dig into it and look at it a little bit more. So the way I have to organize the discussion is just an examination of just some of the sample properties of Bitcoin, primarily focused on the returns, but I did want to say one thing about the prices because it's an interesting contrast to the returns. And then I'll go dig into my study on the determinants of Bitcoin's beta. And so we did a fairly thorough analysis of how the beta moves over time and also how it moves over scale. And under all of the models we examined, we saw a very large jump in March of 2020. And so this is what we've been trying to understand. So we're going to look at some macro. I'll also show you the relationship between a set of macroeconomic indicators in Bitcoin's beta. I'm not going to have any definitive answer. I think it's still a work in progress in that respect because, well, you'll see. But basically, we find that none of the macroeconomic indicators explain the jump in the beta. So we're still looking. So this is probably a familiar picture to everybody. The price of Bitcoin from 2015 in this case through the end of 2023. And I'll spend a minute talking about the price because when I show you the returns are going to look pretty much in line with returns of most financial assets, but the price itself doesn't. And just looking at it, we all know how Bitcoin's price can be highly volatile, and it brings about some interesting statistical characteristics as a result. And so I wrote here: are there speculative cycles? Possibly. That wouldn't surprise me given the nature of the asset. And are these cycles, could they be classified as speculative bubbles? Possibly. And so a quick test of this, and again, this is the price, not the return, where I just treat the price as a random walk. And basically the test is that the null says that the price is a random walk. The alternative hypothesis says that the coefficient, rather than being equal to 1, is greater than 1. So it has explosive properties. And so this is the concept of a speculative bubble in time series analysis. And so I did a quick analysis on that. And you can see on the chart on the right, the chart on the left actually used monthly data for this. It's just a little bit easier. But the chart on the right shows the test statistic. And the statistic varies by time. And you can see the dashed red line is the critical value. And what you see, there are two, actually three. Well, we'll say there are 2 periods of when there is a significant speculative bubble in the price of Bitcoin, which is interesting. So one back in 2000 and the 16 to 18 period, it ended in 2018, and then one right before. See if I can get a better look at it. Run right around the COVID time, and so that's that. The interesting thing about that is that when we take a look at the returns, so prices are a little bit unusual. Most assets, well, many assets don't experience speculative bubbles, but the returns themselves are quite they exhibit characteristics that are quite common among asset returns in general. So if you look at the Bitcoin's autocorrelation function here on the left, you can see that there's obviously remember, this is daily data. There is some correlation over time, but it's not huge. But if you look at the absolute value, or if you were to take the square of the residual, the square of the returns, you'd see that there's much stronger correlation. So this is this heteroscedastic effect is very common in assets, and suggests that the main relationship over time is nonlinear. So in that respect, the returns, well, the prices have this interesting speculative bubble aspect every few years. The returns themselves seem quite normal, shall we say, or very similar to regular asset returns. If you look at some of the summary statistics, I compared it here, Bitcoin, the mean return, the daily return, standard deviation, skewness, excess kurtosis, and then the range, the min and the max. I compared that to a market portfolio, which I'll define in a few minutes, as well as a portfolio of aggregate equity and aggregate bonds and a portfolio of gold. And it shouldn't be any surprise to anybody. And by the way, this is daily data from January 1st of 2013 through the end of 2021. This chart goes through. What you can see, of course, is that the mean daily return for Bitcoin is quite a bit higher than, say, the market portfolio, and larger by a factor of 10. The volatility of the standard deviation is also higher. But what I found very interesting is when you look at the skewness, it's not nearly as negatively skewed as these other assets, as the portfolio, gold, or equity, which all seem to have a very similar negative skewness. And the kurtosis, right, the degree of peakiness of the distribution of returns, isn't the highest kurtosis among this group of assets. So there's some very interesting characteristics about this asset. The price I find interesting in that it has occasional speculative bubbles, and that's the nature of the asset, I suppose. But the returns are not, aside from being pretty impressive, are not all that different in terms of the higher moments from other assets. So I'm going to use this market portfolio, which I'll define a little bit more, to kind of evaluate the systematic risk of Bitcoin. One other quick thing I wanted to take a look at was I want you to see the relationship, the correlation, simple correlations of Bitcoin with gold, bonds, and then I split the market, the equity market, into non-durables, durables, into industry sectors, 10 industry sectors. And all the correlations are really low. That's so Bitcoin does not correlate very, very well with assets, which is good for a portfolio. And I think in the early years of Bitcoin, this was considered perhaps one of the big benefits of holding it in a portfolio. If you look at the principal component of the assets, here I have the first two components, and this is all the assets over time. So it's the 12 equity indices that go into the equity market piece, as well as gold and the bonds. And you can see that this is kind of interesting that Bitcoin and gold don't load at all on the first principal component, and they have a high negative loading on the second principal component, whereas all the other assets load on the first principal component and have almost no loading on the second principal component. So it's actually the opposite. So in some respects, I've read comparisons of Bitcoin to gold and stuff like that. So this is maybe the only evidence that I've seen that would indicate that it is somehow a substitute or something for gold. Now, the portfolio that I'm going to use is a little bit a broader, more market portfolio than that's standard. Normally, people just use, say, for a market portfolio, say the S&P 500. But I was trying to capture the broader market because I was thinking in terms of an investor who has other options, right? Investors can buy equities, but they can buy bonds and they can buy gold, and they do. And so I basically created a way to a portfolio of daily returns from the equities, bonds, and gold. And you can see the proportions, and gold's just a tiny proportion at the beginning and the end of the sample. It's between, it goes from 30 basis points to a third of a 0.4% down to a third of a percent. Equity goes from a little more than half of the portfolio AUM to about 2/3, and then gold comes down. The bonds come from about 46% down to a third. So that's the portfolio. Considering the market risk models I used are pretty standard models. I'm not sure if you folks are familiar, how familiar you are with them, but I'll go through them really quickly. The standard one-factor model, capital asset pricing model, just prices an asset, in this case Bitcoin, relative to the market portfolio, which I defined on the previous page. So the beta here will be the relative price, and obviously it's the covariance of the Bitcoin returns with the covariance of the market returns divided by the variance of the market returns. In other words, it's a regression coefficient. This model is reflected in terms of excess returns, so all returns are in excess of the risk-free rate, which is a 1-month treasury rate. And so in principle, according to capital asset pricing model, this alpha should be 0. You also look at this 4-factor model, which is a little less common, but trying to add factors into the model to perhaps reduce get a better feel for what's driving the risk associated with Bitcoin. And so in the 4-factor model, we have the standard 3-factor, which is the Fama French 3-factor model, which includes the market returns, a measure of market cap size, which is portfolios, small portfolios minus large portfolios, and then a measure of growth versus value. And the last component is the momentum factor. And then finally, there's a model that Fama and French have worked up, I think, in the past 5 or 6 years, which adds, doesn't include momentum, has their size factor in the growth versus value. It includes an investment factor, which is conservative versus aggressive investments, and a profit factor. And so I've estimated those models under different circumstances. Primarily what I did to mimic the experience of an investor is I roll the model. I use a 250-day rolling regression. And so this is the single factor model, and all my charts are designed the same way. On the left-hand side is the vertical axis measures the beta, right? So that's the systematic risk. On the right-hand side, it's T-stat for the beta. And then I just put in some boundaries. So notice that the plus and minus 2t, which would be reasonable measures for a statistical significance, are down here, these 2 horizontal lines. So what we see over time is that the beta, the solid line, and the t, the beta is not significantly different from 0, except there's one bump back in 2018 as we roll along, and still we can see the t is insignificant, the beta is not significant. And when we get to COVID, to March 2020, and it's a little hard to see from the detail on the graph, but it is March 2020 and just jumps up. And so now the beta goes to 1, and it just starts trailing up. It peaks up here around, goes to about 2.5, and lately it's dropped off. So this but you see the T-stat is strong. So this is something new. So historically, there's been basically the beta is 0, which would make to some extent a very good asset for diversification. But since COVID hit, the story is quite different. The beta is positive, and significantly positive, and quite large. When an up around 2 looks like a tech stock almost, and though it has come down recently. Toward the end of 2023, it started coming down. So my main concern was, or just my interest was, what's driving this? And so maybe not so easy to figure out, But I looked at it in all kinds of different ways. One thing is I looked at the wavelet coherence, which is something I always do because I like this fact that it gives me not only the movement over time, right? So this is basically giving me the correlation or over time between Bitcoin's returns in the market portfolio, but it also tells me over scale. So there's an inverse scale. So this is 256 days. And the way you read something like this is clearly the red zones, the hot zones are where the correlation is the highest. And so you can see that these jumps in correlation kind of match with if you go back, they more or less match with the jumps in significance that I saw in the line chart from the rolling regression. But they seem to be at a scale or an investment horizon, if you will, of about 64 days. And at higher frequencies up here, say 4 days, you see a lot of sporadic movement, but you don't see much. So it's kind of an interesting analysis, just suggesting that there's some scale factor in there. This is not unusual. When I estimated beta on other assets, I found that the scales can differ, the betas can differ quite a bit over scale, which has implications for investment horizon. If you think you're investing in an asset with a beta of 1, and it may be 1, but it may not be 1. It depends on how long you hold it for. And so that's kind of what I was hoping to get out of here. And I did get a glean into it. One way to deal with this a little bit more specifically with regard to the asset pricing model is to take a sample, we'll call it critical sampling. This is a continuous wavelet transform. Take a critical sampling and just create, rather than have that the previous chart, the continuous wavelet transform, we have a discrete wavelet transform that breaks the series down into a set of basically 7. In this case, I think I had seven time series that basically represent this chart. And so in that world, I was able to actually estimate a beta, call them a scale beta, right? So I performed a discrete wavelet transform on both the returns for Bitcoin and the returns for the market, and regress them against each other. And let's see what we see. Here's just the simple, by the way, the beta for the entire time series was 0.9, even though you saw when I rolled it through, it was non-zero. It was essentially 0 until COVID hit. But if you look at the whole regression, if you just did a regression for the whole time period, you get a 0.9, and it would be highly significant. But it's just because of the last few years, which is why we roll it through time. The scale beta ranges. This is not unusual for scale betas. You don't necessarily expect them to be monotonic. They're all statistically significant, and they will tend to almost be monotonic. That's how starting from D2 through D6, they increase. Now, this is not the whole analysis in the sense that we still want to look at these over how they change over time, but it gives you some feel for it. But these the high betas at scales 5 and 6 and 7, they're certainly consistent with the high coherence that we saw in the continuous wavelet transform. So here's another chart. Let me expand this a little bit. This is the beta over scale and time. And so I just took each of those wavelet betas based on the discrete wavelet transform and did a time varying, a very simple, poor man's Kalman filter, a very simple time rolling window regression on the discrete wavelet transform. And you can see I use it again on the right-hand side is the T-stat, the left-hand side is the beta, and these are for the different scales. So this D1 is the highest frequency, and D6 is the lowest frequency, and you can get a feel for how the betas are moving here. And in just about every scale, the beta becomes significant after COVID, but not necessarily, not every scale, but well, here, yeah, this one, it's not necessarily as big, so it's a little hard to read the scale. But 5, yeah, 5, 6, 7. So it's pretty much the case that the jump occurred across scale at that time period. One of the things that, so I mean, it wasn't, I have got more in my paper, and I've got a bunch of stuff that I did separate from the paper. If anybody's interested, I could send it. But the at this point, I've convinced myself, okay, the beta for Bitcoin varies. Not only to vary over time, after COVID, it jumped and it stayed up, and it's come down a little bit, but it's still positive and significant. And this is something that wasn't true before. So then the question is why? And so one suggestion that we've been working with, my co-author suggested that maybe it has to do with the rise of DeFi. And certainly around the time of COVID, I don't have the chart with me, but it's in the paper, that around the time of COVID, DeFi addresses, I guess it was, or unique addresses, and took off. And so I think there was a big increase in DeFi at that time. I wasn't able to find any systematic relationship in terms of the modeling. So what I did, though, is I turned to I built a model that to look at the economic determinants of the beta. Now, remember, the beta is basically the covariance, right? So it's going to be the covariance between the returns for the market and the returns for Bitcoin scaled by the variance of betas, the returns, the variance of the market return. And so what I did is I used this basic state space model, and where the measurement equation is the left-hand side of the measurement equation is the beta hat. It's the beta that I estimated over time. And then it's equal to F, which is just the set of factors, times X, which is the state, okay, the unobserved state, plus the disturbance term. And then the state equation just follows a first order autocorrelation. So you can just view it as a first order vector order regression, actually, the way it's written. So I just considered two approaches, and I only put one approach in the paper because they're very similar, and the results didn't really make any difference. But what I did is I said, well, in one case I said G, the factor here in the state equation, is an identity matrix. And in the other case, I considered the fact that G was not an identity matrix. And so, and I'll talk first about the first case. This is an interesting model. It's very flexible. I'll call this model 1, right? And what I used a Bayesian approach, obviously, to estimate this model. And I allowed for a stochastic volatility in V, the variance of the measurement equation, and I allowed for shrinkage in X, the states. And so this way I can put in a bunch of states, and if they don't matter, the way the specification works is quite interesting. This is, if you're not familiar with this model from Biddo and Frewer Schneider, you should read it. It's absolutely a lovely model, and it's very robust. And what it does is it takes this basic equation where the variance of W, that's from the state equation, is a diagonal. It rewrites the equation so that the measurement equation is a function of a set of F times X. Remember, X is a state, that a component of the state equation that's not time variant, plus a time variant component, X sub T, that's scaled by the standard deviation of of W. So they've rewritten. Then in that case, then the the measurement equation is simply a random walk. So what they've done is it's a nice way to write this. And basically what it does is allows the model to have time varying parameters, or if this if the square root of theta is 0, then it could have time invariant parameters, or it could have time it could be insignificant, right? So it allows for all of them. We include the stochastic volatility in the model because that without it, the time varying parameters will probably overfit. They'll just pick up some exogenous volatility. So that's the model. And right, so we've got this constant and time varying piece for each of the states. Let me show you a little bit more about what I did. So here, here's a simple example of it. I took as an example, I took F, the factors are an intercept, the spread between the yield on a BAA bond and the 10-year treasury, and the spread between a 10-year treasury and a 2-year treasury. And so those are the explanatory variables in the measurement equation. And then the B0, B1, and B2 are the unobserved states. So then the measurement equation just looks like this. This is the constant pieces for the betas, and then the time varying pieces for the betas. And then the state equation itself just looks like a first order regression, right? They're not, the coefficients are 1 there. And so in this model, like basically most of the parameter estimation takes place in the measurement equation. All right, so one of the advantages of using a model like this, it's a shrinkage model, so it has lasso type qualities, right? That's why we use it. I can add a lot of variables, and if they're not significant, they're going to drop out. I put a Bayesian prior on them that's centered around 0 and basically challenges the data to say this coefficient is non-zero, right? And so let me just give you a list, quickly go through the list of the variables that I put into the model. So these are variables that I'm going to use to try and explain the change in the beta of Bitcoin over time. So I use the number of Bitcoin addresses, which changed quite a bit after COVID. I use the TED spread, which is a measure of financial distress, daily returns in gold, daily returns in oil, volatility of the S&P 500, this spread between seasoned corporate bonds and the 10-year treasury, the volatility of gold, the 10-year treasury yield less the 2-year treasury yield, daily returns on the NASDAQ tech stocks, a Twitter-based uncertainty index, and an infectious disease equity market volatility tracker. Remember, we're working around COVID time, and an index of Google searches for the word crypto. So I tried a bunch of different factors to see if any of these are driving the obvious, the apparent increase in, well, we'll just say then the covariance between the returns of the market and the returns of Bitcoin. This analysis takes the data through November of 2023, so a little bit farther along in time. And this top line, you get a nice feel for how the charts work by looking at this. The top line is actually the intercept, and the shades are the 80th confidence interval and the 95th% confidence interval. So the first line here is the intercept. The second line is the spread between the corporate bond and the 10-year treasury. So what we see here is that the date, this is COVID time. It's obviously significantly different from 0. It's trending upward. It was not significantly different from 0 for most of the history. Looks like I have the wrong scale here, but I think this is roughly 2018, and then it comes down toward the end of 2022. On the beta for the gold volatility doesn't really matter. could drop it out. We look at the spread between the 2 and the 10-year Treasury. It's insignificant, except this was actually the spike where it becomes statistically significant is right around COVID. The returns on gold never mattered, which is interesting. And think back to that little plot of the buy plot for the principal components, and it seemed like there was some sort of relationship there with gold, but doesn't matter. The relationship with VIX, never really significantly different from zero. And for the oil and for gold, same is true. So it remains to be seen. The most explanatory variable is the intercept. So none of these economic variables have explained the relationship between basically the covariance between the returns on Bitcoin and the market portfolio. I tried, here's the other model. I'll go through this really quickly because I'm more conscious of time, but I parameterized the G matrix. This is a slightly different kind of model, right? Before we used it, we just said this was a identity matrix. And I just said, well, let's say that the state is driven by, the change in the state rather is driven by economic variables. So I used this spread between the corporate and the 10 and the spread between the 2 and the 10 because they seem to matter. At least they did in the initial analysis. And I used the lag of the beta. And so this was kind of an interesting model, but it didn't tell me anything. What it told me was that it told me that the G matrix is essentially an identity matrix. It gave me very small, significant numbers, and it really didn't make any difference. So this leads me to a conclusion, which is that Bitcoin's use, and this is kind of a way to think about it in the paper, the way we thought about it in the paper, Bitcoin's use as a safe asset was certainly put to a test during the pandemic. And to the extent that the beta shot up, it certainly didn't pass the test. It's not a safe asset. One hypothesis is that investors' rapid movement into DeFi, which happened during right around the time of COVID, could be associated with Bitcoin's market risk. And so one thought was that Bitcoin's linkage with DeFi changed the market risk. I obviously didn't prove this. It's just a hypothesis that we're still working on. But the result was that investors start seeing Bitcoin as more like a risky tech stock than they were viewing it previously. And so that's the main conclusion, is that well, this is based on a lot of analysis we've done. It's just that Bitcoin shouldn't be considered a prudent investment option for investments seeking to build a retirement nest egg. But that remains to be seen, I think. Right now, Bitcoin, the best I can say about it is as an asset is it's as risky as a tech stock, and it's pretty much the analysis is TBD. My feeling, and I'll just throw this in, maybe it'll get some questions going. My sense is that the analysis that I'm doing won't really come to fruition until we get some solid use cases around Bitcoin. This is why we were looking at the DeFi, but I think we need more solid use cases to establish a value in the traditional market sense, and then we can evaluate it the way I'm trying to evaluate it. So, all right, let's see. So I guess I'll open for questions now.